May I start?
Yes, please.
Okay. Okay. Assalamualaikum warahmatullahi wabarakatuh and very good evening to Doctor and my fellow friends. We are from 6. We'll present earnings stripping rule, restriction of activity interest, section 103, Income Tax Act 1967. My name is Nafahana and my group members are Akira Fatihah and Kamarul Hazimi. Next. Introduction, most of the multinational companies have external borrowings whereby they will pay the interest expense and other costs. As the external borrowings, the MNCs also have a various arrangement within the groups. So this implementation of ESR to limit the interest deduction for financial assistance between the related persons. This implementation was first announced during budget 2018 to ensure that the business expenses are corresponding with the business income. The objective here, the objective of the IRB publish this kind of restriction. First, to determine the amount of the deductible and restricted in relation to business in business interest expense and other payments are economically equivalent to interest. So next we
Besar
will
gila.
the key features of ESR. Next
Besar
slide.
gila.
Okay. The key features of
Dia
ESR.
dia betul ke
Okay.
dia ke dia macam
Shazah, mute.
kau yang ambil back.
Jaza. Okay. I will continue. Okay.
Fahana,
Okay. For the key
Fahana,
features.
is
Yes.
it possible for you to flip your screen further up? Because I can only see half of your face. Oh, that is the other way around. No, just flip up. I think that's better.
This one.
Okay.
Okay. I will continue the key features. Okay. For the date of effectiveness of this restriction starting on or after 1st July 2019. The scope of ESR about the interest expense in connection with or on any financial assistance that granted directly or indirectly. So the minimum threshold, the rules where this restriction only applicable if the interest expense are more than 500,000. So if the interest expense of the company below than 500,000 and equal, there is no restriction on deduction on interest expense. So the maximum deduction are referred to the maximum amount that the company can deduct their interest expense, which is the 20% of tax EBITDA. So the carry forward rules are the rules where the company must satisfy in order for them to carry forward their excessive interest expense to the next year assessment. So they just need to satisfy the substantial shareholders continuity test and they do not have any limit years to carry forward the interest expense. So the interest expense under the guidelines are referred to the all interest on all forms of debt or payments that equivalent to the interest. The payment that equivalent to interest, we can, for example, profit or loss sharing concept in Islamic financing, and also any capital gain or loss on issuing or subscribing the debt instrument.
Okay, Farhana, can I stop you? The interest on all forms of debts, it means that if company take loans either from their related company as well as from financial institution, that interest is restricted, is it? Or only from related company?
Only I think only for related company and financial institution. Later we have the list of financial institution that excluded from this restriction.
So this one, can I say that we only refer to the interest expense that you pay to your related company, which is restricted?
Yes.
Okay.
Okay. Okay. Next. Next slide. Okay. We continue with the key features. Financial assistance. It means that any kind of monetary help that a person receives, it includes loan, interest-bearing trade credit, advance, debit, or the provision of security or guarantee. So next, a contract transaction are the financial assistance that occurred between one of whom has control over the other, or both of whom were controlled by the third person that we call as the third party. So test EBITDA we can get from this formula A plus B plus C, where A adjusted income that we calculate uh, according to section 4A without applying any restriction yet. So B qualifying deduction consists of 200% of amount incurred and deduction under section 154 clause 1 clause B. So total interest expense interest expense that that have a relation with a financial assistance that have been received. So next person that can be excluded from this restriction. First, an individual. Second, a property developer as defined under Income Tax Property Developer Regulation 2007. Number three are construction contractor as defined under Income Tax Construction Contract Regulation 2007. Next, licensed financial institution. We will look the list after this. And next, last but not least, special purpose vehicle (SPV), as we known as SPE, special purpose entity, as defined under subsection 601 clause 1 of the Income Tax Act. It means that only SPV that established solely for the issuance of sukuk will be excluded from the ESR. So next, we will look the list of financial institutions that will be excluded. We have bank, investment bank, insurer, professional insurer. We have Islamic bank and Takaful. We have Labuan Bank and Investment Bank, Labuan Islamic Bank and Islamic Investment Bank. We have Labuan Insurer and Reinsurer, and also Labuan Takaful and Retakaful, and also Development Financial Institution. For example, for Development Financial Institution are Bank Simpanan Nasional, BSN, and also Bank Rakyat. So next, yeah.
I want to ask,
Yeah.
earlier you said that calculation A, B, C, right? And then C is the interest expense limited only, kan? C represents interest expense that is limited, right? After restriction. Okay?
No. It's,
All.
the yeah. See, the total interest expense that we don't what we call, we do not restricted yet because we
So it's the total
get,
interest expense.
yeah, it's total interest expense.
Oh, so when will we deduct the restricted part?
Later.
Oh, later.
We will look later.
Okay. Sorry for interrupting.
It's okay. Okay, later pula. Okay, next I will pass to Akila for example. Thank you.
Okay, can you all hear me?
Yes.
Okay, so next we proceed to the example in terms of the key features that explained by Farhana just now. So in a control transaction, how we can know that transaction as a control transaction? So this subsection 140A, 5A can be applied as a control transaction in section 140C. Okay, so the subsection mentioned about the existence of control where the share capital held by a person or the third person is 20% or more. So along with satisfaction of the following economic control condition. So there are three following economic control condition. So the first is a business operation of a person is depends on intellectual property right that provided by the other person or the third person. So this we can see later in scenario 1 for the clear understanding. So B is about the business activities such as purchases, sales, receipt of service that influenced by such other person or a third person. And this we can see in scenario 2 later. So the C is about one or more of the director or member of the board of directors of a person are appointed by the other person or the third person. So yeah, the law, the what we call the sentences of the law is quite complicated. So we move to the scenario. Oh, sorry. Okay. The first scenario of control transaction is, okay, in this scenario, ABC company owns 25% share of ABC Sdn Bhd. So ABC Sdn Bhd is released solely on intellectual property. Released solely is mean depend. That's why the arrow above the picture say that ABC Sdn Bhd use of patent rights that owned by the ABC company. So this under condition of having more than 20% of share capital. That's why and also the economy control condition of the business operation uh, by uh, by by a person, it means ABC company, ABC Sdn Bhd is depend on the intellectual property owned by ABC company. So because of this, all the payment of interest by ABC Sdn Bhd to ABC company will be subjected to interest restriction under section 140C. It mean earnings stripping rules lah. Okay.
Okay, hold on. So it means that in this case, you fulfill the first condition more than 20%. And
Yes.
the second condition is the blah 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 scenario 1, is it?
Yes.
Okay. But in this case, we assume that ABC Sdn Bhd take loans from ABC company, which is a related company or control company. And for that loan, the company has to pay interest.
Yes.
But because of that condition, the interest is restricted.
Yes. Yes.
Okay. So can you go back to the scenario 1 again, to the earlier slide? Okay.
This one, Doctor?
Scenario 1 is that the business operation of a person depends on intellectual property rights such as da. So that's why in your example, Sdn Bhd company, ABC Sdn Bhd relies solely on intellectual property. So in this case, number 1 is that you have a control company. Number 2, because it relies solely on the intellectual property. And if the company ABC Sdn Bhd pays interest expense to ABC company, then the interest expense is restricted to 20% of EBITDA.
Yes.
Correct?
Yes.
I'm
Betul.
not sure about others, if they get the same idea. Because this is very new, because this one very recent, 2019. I would say it's a recent law, right? So that's
Yeah.
why I'm trying to understand correctly. Okay, thank you.
Okay. So next we go to scenario 2. So in scenario 2 is ABC company hold 35% stake in ABC Sdn Bhd and also own 65% equity capital in XYZ company which is in outside Malaysia, country outside Malaysia. So in this case, ABC company direct ABC Sdn Bhd to buy raw material from XYZ company. So this is this equal in criteria B that provide the business control condition that business activity such as purchases that related to the condition that relation supply or influenced by the third person. So because of that, any payment by ABC Sdn Bhd to ABC company or XYZ company will be subjected to interest restriction under section 140C. Okay. So
Okay. Sorry. Can you just go back to your earlier slide on the scenario 2? I just want to get back. Business activities such as purchase, sale, receipt of service of a person are specified by the other person. So in this case, company ABC company specify to ABC Sdn Bhd to purchase from XYZ Co.
yes,
So that's the second condition.
yes,
So because you fulfill the first and the second condition, then any interest payment made by ABC Sdn Bhd to ABC Co or any XYZ Co, the interest is restricted.
yes.
Correct. All right. Thank you.
Okay, thank you to Doctor. Okay, next we go to scenario 3. So in scenario 3, ABC company
Before you do that, can you just
okay.
go back to scenario 3? Fahamkan dulu what is the scenario 3. Then
Okay.
you look to the example. One or more of the directors or members of board of a person are appointed by the other person. Okay, now you can go to the example.
Okay. So, okay. This is when ABC company has power to appoint one or more director or board of director in both ABC Sdn Bhd and ABC and PQR company. So this we can tell ABC company have their power to appointed. So just like a third person of the another person of the outside company that appoint the director to ABC company ABC Sdn Bhd and PQR Sdn Bhd PQR company. Alamak, faham tak? So this is provided that ABC company have a more 20% share in ABC Sdn Bhd and also PQR company. This transaction is a control transaction. That's why ABC fulfill the third criteria that have a power to appoint one or more director and member of the board of director in ABC Sdn Bhd and PQR company. That's why any payment of interest that by ABC Sdn Bhd to ABC company or PQR company will be subjected to interest restriction under section 14C of the Act. So yeah.
Very good.
Okay, so this criteria will help the company to determine whether the transaction is a control transaction or not. Okay, so next we proceed to the example to determination of the de minimis threshold. Okay, so as mentioned by Farhana, the company can see whether section 14C is applicable or not for that company. First is when total amount of any interest expense is equal or less than 500,000 is not applicable. The second one is company have a multiple business sources. The company must accumulate all the interest expenses of the business sources. So the total will be compared by 500,000. So if less, so the section 14C is not applicable. But the difference is when having multiple business sources, the calculation of interest restriction of the should be
Hold on.
met.
Company A, interest expense 500,000.
Yes.
But you say that it's not applicable if the amount is 500 equal to 500,000.
Equal
So
or
101 dia
less.
akan kena lah.
Apa doktor?
500001 dia akan kena lah.
Yes, is applicable.
500 and below tak kena ya. Okay.
Yes. Okay, so we can see company A have interest expense 500,000, so equal to 500,000. So section 14C is not applicable. So company B have interest expense total 1 million, more than 500,000. So section 14C is applicable to company B. So in company C have interest expense 450,000, so less than 500,000. So section 14C is not applicable. So company D have a 1 million interest expense, so more than 500,000. So section 14C is applicable for company D.
What's the difference between B and D?
Company B have a 1 business sources and company D there are 4 business sources.
It doesn't matter.
Yes. For the company must take note.
Accumulated from all business source lah.
Yes, yes. Okay.
Okay.
Okay, jap next. Okay, so next we go to example computing the tax EBITDA and interest expense restricted by ESR. So given the information, XYZ company's adjusted income from its business for year 2020 is 3.3 million and their expenses for qualifying deduction is 100,000 and their interest expense that deductible again XYZ business income before ESR is 1 million. So 1 million that is include all the interest expense that I mentioned that above table below. Okay, so next. So the first step is to computing the tax EBITDA. So
sorry, this one is for XYZ Co.
Yes, yes.
So means that XYZ Co is the one that pays interest.
Yes.
To ABC Co, for example.
Yes.
Okay.
Okay. So that information before their adjusted income as formula as a 3.3 million. For the qualifying deduction straight directly given in the information 100,000. So the interest expenses is 1 million. So we plus all these three, we can have a tax EBITDA 4.4 million. So the next step is we must have to identify the maximum amount of interest expense deduction using the fixed ratio formula. So the fixed ratio is 20%, that will be times by the 2 is mean the tax EBITDA. So 4.4 times 20% times 4.4 million, we can get 880,000. Okay. So after that, we want to know allowable deduction expenses, interest expenses that will be allowed to deduct under ESR. We choose which lower of maximum amount or interest expenses. So in this case, the interest expenses is 1 million. So the maximum amount is 880,000. So we choose maximum amount because that is lower. So 180,000 as allowable deduction of interest expenses. So the next we compute the current year excess interest expense that restricted by ESR that can be carried forward. So this will be formula that 1 plus 3. 1 is interest expense and 3 is amount that allowable deduction of interest expense just now. So 1 million minus 880, we can get 120,000. So this amount will be carrying forward for the year 2020. Okay, that's all for me. I will
Okay,
pass.
hold on.
Okay.
Alright, in arriving to adjusted income, kan? So you start from profit before tax, you plus minus adjust expenses, right? So maknanya in arriving to adjusted income, how much was the interest expense deducted? 1 million ke 880 in arriving to the adjusted income of 3.3 million?
1 million. 1 million doktor.
Ha?
Sebab dia tak apply
betul.
restriction yet.
Lagi sekali tak faham.
Yes.
Lagi sekali?
1 million.
Okay, in arriving to adjusted income, you allow
Yes.
1 million.
Yes.
You allow 1 million. Tu you add back ke macam mana? Because now your interest expense incurred is 1 million. But based on this, you can only allow maximum of 880 to be deducted. So the 120 is the non-deductible expense, isn't it? Or I got it wrongly.
If I'm not mistaken, before we came to the adjusted income, the interest expense have been there is not specifically in paragraph 3.6 that mentioned by Farhana that include in this guideline lah. So we add back interest expense that have a criteria that can be include to.
Because for me, what I understand is that now, based on your computation, your allowable deduction expense should be only 880.
Yes.
So maknanya pada 1 million interest expense, 120 is not allowed. Macam mana tu? That's how I see it lah, because it means that kata interest expense is restricted. So of the 1 million interest expense you have, you can only claim 880. 880 is allowable. So means that the balance 120,000 is not allowed. So but I do not know how you do the adjustment then.
Can I nak cakap?
Ke ada example lepas ni?
Example lepas ni about carrying forward this amount 1 to.
But that's why 120 ni bila you carry forward, but those are the amount which is not allowed to be deducted during the year.
This will become unabsorbed to the by unabsorbed interest expense this year that can be carried forward to the next year.
So maknanya this year, what I understand that you can only allow 880,000.
Yeah.
So that balance 120 you carry forward to next year and see whether you can utilize that 120 in the following year. Is it?
Yes.
So maknanya in arriving to adjusted income tu balik, you should tolak 880 je lah, allowable expense.
Okay. Hello.
Tapi kan doktor, dalam guideline by
Boleh saya
IRB
tunjuk guideline doktor?
dia tunjuk yang dia beritahu yang section yang adjusted income tu sepatutnya belum apply section 140C.
Oh, you tak apply lagi. So you claim
maksudnya kita
1 million lah. Okay, tak apa.
Apa yang saya faham lah.
Okay, let's go to the next slide. Maybe I can see the missing information here.
Okay.
Next slide. Okay, thank you, Abdullah. Next, we moving to carry forward rule. On carry forward rule, interest expense of a company which is restricted by ESR qualified to be carried forward and deducted against income of subsequent year assessment. As we know that the maximum amount of the interest can be deducted is 20% of the tax EBITDA for a year assessment. So the excess amount of interest expenses will be carried forward for the subsequent year assessment until the whole excess amount fully utilized. So basically, there are some rules need to be followed before eligible to carry forward interest expense. The first one is company must ensure that its ordinary shareholder for the subsequent year assessment remains substantially the substantially the same on the first day and the last day, meaning that the shareholders of the company on the first day and the last day of the basis period for year assessment following the year in which such amount of assessed interest was remain substantially the same. To remain substantially the same, the shareholder of the company need to be more than 50% of the paid up capital and the value of allotted share in respect of ordinary share of the company held by or on behalf of the same person. If this criteria doesn't meet, the unabsorbed interest expense is to permanently disregarded, meaning that it cannot be carried forward for further year assessment. Okay, next slide. Okay, to make it clear, given that two scenario, which is scenario A and B, whether company eligible to carry forward or not. On scenario A, on the 1st July 2020, which is the first day of year assessment, the paid up capital and value of allotted ordinary share held by Mr. A is 51%, and the last day year assessment, which is on 30 June 2021, is also the same. It shows that their ordinary shareholding remains substantially the same and more than 50%. As a result, it can carry forward unabsorbed interest expense for the next year assessment. But on scenario B, it cannot carry forward and permanently disregarded because their ordinary share remain substantially the same on the first day and the last day of year assessment, which is Mr. A no longer hold more than 50% paid up capital and value allotted ordinary share. Okay, next slide. Okay, this is example of utilization of unabsorbed interest expense. Continuing example from Akila that be presented just now, starting with 2020, their interest expense incurred is 1 million. This amount is from C, interest expense on calculation of tax EBITDA that be presented by Ila. Maximum amount of interest expense allowable is 20% of the amount tax EBITDA, which is 80%, which is 880,000, where 4.4 million times with 20%, and we get it. Okay, now their total interest expense for the year is 1 million, where current years with unabsorbed interest brought forward. Since this company don't have brought forward interest expenses from previous year assessment, so the amount is 0. Okay, to identify the unabsorbed interest expenses to be carried forward for the next year assessment, total interest expense for the year minus with maximum amount that can be deducted on interest expenses, and we get the carry forward interest expenses, which is 120,000. Okay, next on 2021, the maximum amount on interest expense allowable is 600,000, which is higher than interest expenses of the current year 550,000. But we have to add it with unabsorbed interest expenses, which is brought forward with interest expenses brought forward, which is 120,000. So the total interest for the year will be 670,000. Interest expenses that need to be carried forward for the next year assessment is 70,000 after minus with maximum deduction 600,000. Okay, now on 2022, the maximum amount of allowable deduction is 1.4 million, which is higher than total interest for the year after adding all the brought forward interest expenses. So the current year allowable deduction is 870,000. That means that on 2022, they has fully utilized the amount of excess interest. Okay, next slide. Okay, this one actually same on the calculation of previous example. It focus on excess interest expenses specified that each amount that need to be transferred in the tax computation. For example, on 2020, current year excess interest, which is 120,000, will be transferred back in the tax computation on calculation on profit before tax, where we added current year excess interest expenses to get the adjusted income. While on utilized excess on 2021, we minus the amount 50,000 ringgit to get adjusted income. In the end, 2022, we can see that there are no excess amount because it has fully utilized it's already fully utilized and deducted. Okay, next slide. Okay. As a conclusion, with the ESR rule coming into effect on 1 July 2019, the taxpayer should review all the financial arrangement to make sure that the scope of arrangement falling under ESR rules. So they need to determine whether ESR is applicable or not on their business, and also consider its tax impact. On part of that, it will be essential for the company to understand the mechanism of ESR and prescribe formula to ascertain the tax EBITDA in order to determine the amount of interest restricted. So after the evaluating of the tax impact, company will have to review all their debt profile and have to look at option or alternative to restructure existing borrowing and formulate strategy for future financial assistance. Okay, I think that's all from us. Any question?
Okay, I want to ask the class to check first to ask question. Maybe we can go back to Kamaru punya presentation on the computation just now. Ada public ruling ya, is it? Alright, this one kan?
Yes.
Alright, your interest and expense incurred is, let's say 2020. Okay lah, expense incurred is 1,550,000 and 800. And then tax EBITDA is that amount. And then the 20% of that is you have 880 and 1.4. Okay, so you know that this is the amount which is allowable. The 880 is the amount of interest allowed.
Yes.
So current year interest is 1 million, but but the amount allowed is only 880. So the different 120 you carry forward. Kan? For
Yes.
the 2021, you allowed is 600,000, but the current year interest is 550, so you take the lower.
Yes, lower.
Yeah, so 550 you take the lower. Total interest expense for the year is 670. I tak faham. Total interest for the year is 670 tu mana dapat? 550 to 120.
550.
So you have the current interest expense is 550. The maximum amount allowed is 600.
600.
Okay. So you punya interest current year 550 plus brought forward ada 670.
Yes.
But because you actually incurred 600, so amount allowed is only 600.
600. That maximum amount can be deducted.
So you can claim 600,000 lah. Instead of what you actually incur is 550.
Yes.
For the year, but you can claim 600.
So the remaining 70,000 will be carry forward.
You carry forward again. Right? But for 2020, you don't have any current year unabsorbed lah. Because everything is absorbed.
Because this maybe the first year they don't have the previous unabsorbed interest expenses brought forward.
Okay, so first thing you must know how much is the interest expense incurred. Alright, so the first level. And the third line is that for you to determine how much the maximum interest that you can claim. But how much you can actually claim also depends on how much you actually incurred, because you have to take the lower off. So in the case, for example, 2021, interest incurred is 550, you can allow 600, but the one which is, the maximum allowed is 600, but because you actually incurred 550, So you can only claim 550 lah instead of 600, isn't it?
Yes, Doctor.
Plus 120, so dapat 670.
70.
Total interest for the year is 670 but allow only 600.
Ah,
So during the year you only claim 600 lah.
yes, 600.
So the 70
maximum
you
amount.
carry forward to next year.
Yes.
So next year you interest expense is 800. 20% of that is 1.4. Okay, so you have 800 plus 70, 870. So maximum 1.4 but you actually incur 870 only. Then you claim 870. My question is 870, 880 dengan CRA nak claim kat mana? In your tax score.
We choose the lower right, the lower interest.
So because they have decided that the last line is the one that you're going to claim. Kan? This is the amount allowable for deduction for your interest expense. 880, 600 and 870. But where do you claim this?
On tax computation.
Tax computation. Okay, so it means that kalau dalam tax com you, assuming that you start from profit before tax, okay, so you akan add back 120 lah in 2020.
Yes. Minus.
Huh?
120.
Kenapa minus lah?
But
you dah claim 1,000 because yang allowed is 880. You dalam you punya profit and loss account is 1 million. You should add back 120 lah kot.
Doktor add.
Minus lah.
You add back. Because that one is not allowed kan?
Yes.
When it comes to 2021, actual is 550 but now you want to claim 600. So you're going to minus 30, isn't it? Malah salah. Interest expense increase 550 but you can claim 600 so you're going to minus 50,000.
Minus 50.
Betul?
Betul.
What about 2022?
22, we minus 70,000.
Yes, minus 70,000. Why? Because actually incurred is 800 but you can be allowed to deduct 870. So you can minus another 70,000 interest expense. That will be the adjustment. Faham? Okay. Group Hana, what about the others? Class? Okay, assuming that I give you this question in the exam, in the final exam, right? I give you the interest expense. Bagi sebelum tu, before that, the slide before. Oh, ni tak ada. So I give you scenario for 3 years, for example. No, just now, the computation just now. Right? It means that you should be able to do the computation, this one. You should be able to advise the company on how much is the allowable interest expense under apa nama dia tadi? Earnings Stripping Rules, ESR.
ESR.
Okay, kelas, boleh kita tanya lah. I nak tanya Eng Sang Hun. Are you here? Wah, mana ni? Mana yang lain ni? Yes? So, do you understand the topic? Eng Sang Hun? Dia jawab yes je. Yes apa tu? Yes faham. You understand the topic Okay. No question from the class? You better ask now You ask later just before the exam they will forget. Okay. Alright. I think that's a very good presentation. It shows your understanding on the topic. All right, and it's a very important topic actually for this ESR. I hope that everyone benefits from the presentation. Thank you again to the group, and yeah, that's it. Right?
Okay, thank you. Thank you, Doctor.
All right. So can we have the second group?
Tunggu ah.
Yes.
If you can you see the full screen? I open now.
Yes.
No, I haven't opened yet. Yeah, okay.
Okay.
I can see, right. All right. So good evening, everyone. My name is Wong, and we are talking about group relief topic today. And my teammates is Kavita and Sangavi, which will present later. So begin from the introduction. The existing Act treats every company as a separate legal entity, notwithstanding that some may be part of the group in substance. So there was a group of company which involved a couple of small companies. Those small companies, they treated as separately based on the Act. So business losses and unutilized capital allowances are retained within the company itself and not utilized by other profitable companies within the group. So the loss of that small company cannot taken by the bigger company to handle the losses. So this result in tax inefficiencies for group operations and unnecessary costs incurred on tax planning to maximize their tax efficiency. Malaysia, they must provide the tax neutrality in order for Malaysian group companies to remain competitive. Thus, the government allowed group tax relief to be claimed with effect from year assessment of 2006 onwards. So with effect from year assessment 2009, a loss-making company, which we will call it surrendering company, that will be mentioned a lot in next. It's allowed to surrender not more than 70% of its current year business loss. So that loss-making company, they cannot surrender all of the business losses, only 70% of it, to the one or more related companies, which we call as claimant company, with the condition where the claimant companies are tax resident and incorporated in Malaysia, related companies throughout that year and 12-month period prior to that year assessment, paid up ordinary share is more than 2.5 million at the beginning of the year assessment, having common 12-month period ending on the same day, make an irrevocable election to surrender or claim the business loss in their respective tax return form C, subject to item tax at 24%, starting from year assessment 2016 to 2020, and the claimant company has defined aggregate income for that year assessment. So they must meet all these conditions in order to surrender the losses to claimant company. So for related companies, it means that at least 70% of the payout ordinary shareholding either owned by surrendering company or claimant company or commonly controlled by another Malaysian resident company. The 70% shareholding not necessarily be directly owner, it can be included control through another company. So the second one means that even though the company A is the company that control B, but A can control C as well because B owns C. So A is indirectly own C in some ways. There was two examples I'm going to show you now. Okay. Example one, company P holds 90% of ordinary shares in company A, while company A holds 95% of ordinary share in company B, and then all three companies are incorporated and resident in Malaysia. So based on the table you see in the left there, actually P holds 90% of A holds 95% of B, then P actually controls B as well. If you multiply 90 multiplied by 95%, which means they indirectly own 85.5%. So basically, he already meet the 70% shareholding requirement. Then the second example is quite longer. I take from the IRB there. So basically, when the question didn't mention on how many percent of shareholding you need to calculate, but according to the rights to share in profits, because in order to you have a shareholding of a company, you must have the share of profits from that company. So we just don't take the fixed dividend only. So based on this question, there was rights to share in profit based on share capital, fixed dividend nominal value, and fixed dividend plus rights to share in profits. So we only take the type 1 and type 3, which is eligible from company profit. So based on the calculation given in the below there, you can find it on the IRB standards there. You can refer many more questions there. So therefore, the percentage of ordinary shares owned by A is 75%, B is 18.75%, and C is 6.25%. So in conclusion, only A have the more than 70% shareholding of company Z. As company however, company A also needs to ensure it owns 70% of the entitlement of residual profits and residual assets of company Z. This is the second requirement, which will be explained in the IRB. That you can refer that because it's quite longer than that. So I will pass to next slide, please. Define aggregate income. So define aggregate income. Group tax relief allows the claimant company to claim business loss not exceeding the defined aggregate income of that year assessment, which computed as follows. You can see the formula there is in the book as well. So the business loss cannot claim more than that value given in the defined aggregate income. So now I'll pass to the next presenter. Thank you.
Hello everyone, I'm going to continue with the loss company. Okay, so like you all know, there is two companies, which is surrendering company and also claimant companies. The surrendering company is allowed to surrender to more than one claimant company, but then the aggregate amount shouldn't be exceeding 70% of its adjusted loss. Same goes to the claimant company, that they can claim for more than one or two surrendering companies. Okay, next. Current year loss. Okay, like I mentioned just now, the amount to be surrendered is actually restricted to 70%. But then, any amount that not surrendered would be carried forward to the next year assessment as unabsorbed business loss. Okay, this means that the 30% from the adjusted loss is actually unabsorbed business loss. Okay, let's look at revised adjusted loss. In case the surrendering company revised their tax computation and finds that the amount that need to be surrendered is actually more than the initial adjusted loss that they already surrendered to the current claimant company, means that they are not allowed to revise the amount that they already surrendered, but the excess would be carried forward to the next year assessment as unabsorbed loss. And if let's say the revised adjusted loss is less than the initial adjusted loss, they need to inform the Inland Revenue Board regarding this deficiency. And if not, they will be charged on tax undercharge, and also there is 100% penalty for them. And next, we look at an example. Okay, the question is Alpha Berhad is an investment holding company which owns 100% and 50% paid up ordinary share capital of Beta Sanjay Berhad and Delta Sanjay Berhad respectively. Beta owns 20% paid up ordinary share capital of Delta Sanjay Berhad. Beta manufactures instant noodles while Delta trades in cars. Okay, this is the relationship between the three companies. Alpha Berhad owns 100% of Beta Sanjay Berhad, while 50% of Delta Sanjay Berhad, whereby Beta owns 20% Delta Sanjay Berhad. In this case, three companies are related because Alpha owns 100% of Beta and Alpha also owns 70% of Delta, which is 50% directly and also 20% indirectly. Okay, next. Next, let's look at the computation of chargeable income for year assessment 2020. The table at the left is actually the details for the year-ended year assessment 2020 that is provided in the question, and this is the answer. Okay, they already provide the adjusted income, adjusted loss, capital allowance, rental income, dividend income, and also approved donation. Okay, the company that having losses is actually Delta over here. So this is the computation. We start with adjusted income for beta, and then minus with capital allowance, and then dividend income, rental income, and after that minus with approved donation, and we will get the aggregate income. Over here, there is loss surrendered. Okay, only delta is having the loss in that year. So delta is actually the surrendering company, and claimant companies are alpha and beta, since they have 70% of they are allowed to claim for them. So the amount that needs to be surrendered is actually 70% of its adjusted loss, which is 3,000 times with 70% is actually 2,100. So in this case, alpha only have 890 as their aggregate income, so they can only minus claim for 890, and the balance can be claimed by the beta Berhad. So the unabsorbed loss would be the 30% of the adjusted loss, which is 900, and also the unabsorbed capital allowance carried forward is actually 1,200. I hope you all understand, and we move to the next one, which is commencement of business. Okay, with effect from year assessment 2019, it is mandatory for the surrendering company to have commenced business for a period 12 months to be eligible for group relief. This means that if, let's say, the company start their business in 2019 and they having losses in that year itself, but they are not allowed to surrender their losses in that year itself, but they can claim their loss in the next year. The amount in the current year loss is actually carried forward to the next year with each unabsorbed business loss. And the next one is transitional provision. Okay, under this act, it is provided that the surrendering company may only surrender the current year loss for year assessment 2019, provided that the company must be first commence its business operation in year assessment 2015. Only the company that start their business in 2015 can claim can surrender their current year loss in 2019. And if, let's say, the company start their business in 2016, they are allowed to claim surrender its current year loss in 2019 and 2020 only. And if they commence their business in 2017, they can claim for 2019, 2020, and 2021 as well. If, let's say, the company comments before 2015, which is, let's say, 2014, they cannot claim for group relief. They are not eligible.
It's 5 o'clock.
For companies actually. And next is tenure of group relief. Okay, section 44(1) provided that the surrendering of losses is actually limited to only 3 consecutive year assessments, which means that, let's say, the company already surrendered their current year loss in the first year and the second year and third year, but then the fourth year they are not allowed to surrender their losses. Okay, if in another case, let's say the company managed to restore its profit in year 2 and 3, but suffer current year loss in year 4, they are still cannot claim surrender their business loss again, because it is restricted to 3 years only. Okay, these scenarios given are the same example as well. If, let's say, the company having losses in the first year, second year is profit, third year also profit, but then the fourth year they are still cannot surrender their business loss because it is restricted to 3 consecutive year assessments. So that's all from me. I'll pass it to my next presenter. Thank you.
So I'll take it from here. Thank you, Kavita and Wong. Okay, claimant company, company which utilize the trading loss of a surrendering company. So it's like the company should utilize the trading loss which have been happened previously by the surrendering company. And then the claimant company has unabsorbed investment tax allowance or current year loss from pioneer business under Promotion or Investment Act 1986 is restricted to participate in group relief. If a company which it already, like the claimant company is already claiming the current year loss from pioneer business or investment tax allowance, it is not allowed to participate in group relief. So which means it cannot claim the surrendering company's loss. So then it should should fully utilize its unabsorbed investment tax allowance or current year final loss before being able to receive business losses surrendered from its related company. As I said before, it has to fully utilize. If, for example, in 2010 until 2030, it has to fully utilize first what the pioneer loss, current year pioneer loss, and also investment tax allowance before it can just claim the surrendering company's loss. Next. So the anti-avoidance, okay. If let's say the tax, okay, here if the company, what I mean by tax avoidance means like if the company fail to pay or fail to claim, or either like they provide incorrect information, what are the rules or what they will be empowered, yeah. So tax authorities empowered under section 44A bracket 9, yeah. And then to make an assessment or additional assessment within 5 years from the end of the year assessment to recover the loss of tax from the claimant company, if it discovers the adjusted loss claim is not valid. So this means, for example, like in 2010, DG discovered that DG means the Director General discovered that adjusted loss should not have been deducted in arriving to the total income. So in 2010, it discovered the loss, which, for example, it discovered the loss happened in 2007 by the claimant, by the surrendering company, but it haven't deducted yet. So in arriving to the total income of the claimant company, the DG may make an assessment or additional assessment in year assessment 2010, or either they can choose 2010 or year assessment 2011 to 2015. After the expiration of year assessment 2010, once 2010 is ended, they have 5 more years to claim the loss. So next would be the penalty of incorrect information. If let's say the company provide any fake information or incorrect information, it should pay fully impose a penalty equal to the amount of tax undercharged by the claimant company on the surrendering company in the event of the surrendering company gives incorrect information. Like 100% tax undercharged by the claimant company imposed on surrendering company. So the surrendering company may like they can maybe within 30 days of being notified appeal to FEIT to reappeal to see whether the like they reappeal to see whether this both if they are not satisfied on the tax. Okay, next. Okay. Next would be mutual exclusivity. The Act doesn't permit the enjoyment of group tax relief if either the surrendering company or the claimant company is enjoying, if either one company is enjoying pioneer status or investment tax allowance. If they already claim this status or investment tax allowance, they are not able to enjoy the group tax relief. And then if they have already have relationship exemption, income tax exemption, reinvestment allowance, revenue deduction on approved food production, cost of acquisition of foreign owned company or proprietary rights or PUA order deduction where the prohibition of group tax relief is specifically stated in such PUA order. So all this, if let's say they already enjoy one of this itself, they are not able to get group tax relief. Next. Okay, for tax administration, the claimant company have to fill up Form C, RKT, which is already available in www.hasil.gov.my, which is, okay, the one in the picture. Okay, both the forms are already attached in the picture, like RKT and RKS. RKT is mainly for the claimant company and RKS is for the surrendering company. Next. So for conclusion, Actually, the group tax relief is a welcome decision, although a long-awaited one. But nevertheless, the limitation is the surrendering company is restricted to surrender 70% of its current year loss only. Not available to be surrendered if it's already have unabsorbed business loss brought before, or unabsorbed capital allowance and unutilized current year capital allowance, it is not able to surrender. And then definition of related company requires more than equal to 7. Yes.
I need to rephrase that. All right. What I think that conclusion here is that it's just that the author, right? The author think that group relief, if you have losses, current year loss, you can surrender 70%. But what it says here is that you, by all these unabsorbed loss brought forward, unabsorbed capital allowance and unutilized CY, our current capital allowance is not available for surrendering. It's not that if you have this, you cannot claim. I hope we have the same understanding.
Yes, I do.
Okay.
Yeah, it's like if they already have this, they can claim, but they cannot claim this. That's what I.
Sekali?
Kalau dia dah ada yang ni, dia still boleh claim yang tu. But they are not able to claim this, right?
Tak clear.
Okay. Dia macam dia dah ada loss, and then
they have current year loss.
That 70% they still can claim, but they cannot surrender the unabsorbed business loss forward, and then unabsorbed capital allowance.
All these things cannot surrender. Right. Of course, the author hope that you can actually surrender all these things. That would be better for companies lah.
Yes.
Yeah. Okay.
So and then definition, this particular topic mainly each the claimant company and also the surrendering company, they should have at least 70% of holding, like what Wong have explained just now. So if they don't have, then they can't be able to claim the losses. And this give rise of grievances from minority interest and may encounter hurdle in its practical application, as surrendering the loss to another company within the group would have to be consented by the minority interest shareholders. So next would be the reference. So we have referred to the public ruling 6/2016. Actually, it is more clearer because it takes a lot of pages, but it has a lot of example, and then we used our textbook. Yeah. So any questions?
I want to ask about the irrevocable election to surrender the claim. Right? So does it mean that for every year assessment, the surrendering company make a loss, the company has to surrender? Is it meaning that once the company is elected to surrender its loss, will it continue forever? Does it? What it means?
Okay, your question, will I repeat again? If let's say they have loss for this year, and let's say they have a loss for the next year, they have to surrender, like every year they have to surrender the loss, am I right?
Yeah, the meaning of irrevocable election, I just wanted to know. I think it was mentioned by Wong Kok Yew.
You mean, what's your question? Want to ask about the irrevocable election? Oh.
Yes.
Oh. So actually, it's like you can claim the business losses with you need to give consent to the shareholders to you surrendering the loss to the main company. Ideas like that. Hello.
Okay, let me help lah. When it says irrevocable, you have two companies, right? The surrendering company and the claimant company. So it says that you make an irrevocable claim. So it means that if you put in the form C that you want to claim or you want to surrender the losses, you cannot take it back.
Yes.
Alright, even though later you find out that actually you have the wrong aggregate income. So whatever is given, whatever is taken, you cannot put it back lah. Alright, you cannot give back to the company, for example. So that's what you meant by irrevocable. Yeah, but again, but also remember that just now we had the example where if the first year you are making losses, the following year you make profit, then the following year you can no longer, even though later you make losses, so the government restrict that. Yeah, so why do you think? Of course, it's good. All right, it's good that now we have a group relief where company is making losses and help other company, which is a related company, to pay lower tax by absorbing their losses. So that's the objective of this group relief, group, right? But why do you think that the government is very, I would say that they are very strict, all right, in terms of the application of the group relief?
That one I can answer that is basically the one I mentioned is 2016, right? But in budget 2019, they got proposed an amendment to the group relief thing, so they only able to claim for 3 consecutive years instead of 5 previously, if I'm not mistaken. And then they cannot brought forward, so they only can claim current year. Yeah.
So why do you think that the government put the rules on this group relief? Why they are very strict about it?
They
okay, you must have at least 12 months commencement.
Yes.
Why?
Because maybe the government doesn't want companies to misuse the act to the group relief thing to lower the payment of tax, like purposely Commencement company.
Because companies are very creative.
Yes.
The government first come out with this group relief and suddenly they just open up a new company, register a new company making losses. And then suddenly losses, then they transfer to the profitable company. All right, so that's why even though we are actually giving this, but we have to monitor because Malaysian companies, they are very creative, right? So that's why we have the tax avoidance. So if you play, government kata, if you play, all right, we caught you, you'll be penalized a lot, all right? So not only you have additional assessment, and then you also be penalized 100% of the tax undercharge. And that's why there are also rules, for example, you must at least commence in 2015, 2016, 17. So that one I'm not sure why they have that, but again, I think that to restrict, right, to make sure that the company don't actually set up a company to make losses so that they can transfer the losses to another company. Yeah. So and again, of course, those company that is already under tax incentive, right? You already have a lot of deductions given, exemptions given, so the company are no longer allowed to enjoy this group relief. Yeah. So I think that's good. Thank you for the presentation. I follow your presentation very well. So I hope that the students, other students as well, benefit from the presentation. Thank you again.
Thank you, Doctor.
Who have presented, please share your slides, yeah, so that I can put that into the Google Classroom for everyone's benefit. Thank you. And we have the next group. The next group is on withholding tax.
Doctor, can you hear me?
Yes.
May I start now?
Yes, yes, sure. Please.
So, Assalamualaikum and good evening to Dr. Khadijah and friends. So today our group will present about the withholding tax. So my name is Raisha Amira binti Azmi and my group members Nur Amira Shafika and Nur Adriana. Okay, so next slide. Next. Mira, next slide.
Yes, please start.
Slide. Simply tak ada slide kat sini.
Well, we can see the slide.
Okay. Okay, sorry. Okay, so this is the definitions of the withholding tax. Okay, withholding tax is actually amounts withheld by the party making payment payer on income earned by a non-resident payee and paid to the IRB. And a payer is referred to an individual or body other than individual carrying on a business in Malaysia. And it is required to withhold the tax on payment for services rendered, technical advice, rental, or other payment made under any agreement. Next slide.
Baby.
Next slide. Okay, so
hold on. Go back to the earlier slide. We have payee and payer patutnya kan? Earlier slide. This one. Okay, payer. Oh, you buat payer. P-A-Y-E-R. Okay. I selalu payer. Okay.
Okay, so this is the yang slide tadi. So this is the simple ways to understand about the definition of withholding tax. Okay, as you can see, payer will make a payment to non-resident for only 19%, and for another 10%, which is the withholding tax, we pay to the tax authorities, which is the IRB. So the payment makes by the payer to the non-resident is actually an expenses, and it will be appear in P&L account. For amount received by the non-resident that pay by the payer is actually an income for them. Next. Okay, so this is the scope of withholding tax. Okay, withholding tax is only restricted to the following types of payment made to non-resident, which are the special classes of income, interest, royalty, contract payment, public entertainer, other income in section 4 subsection F. Okay, so the recipient for all these type of payment are non-receivable person, then we have to withhold the tax. So whatever payment which is supposed to pay, then the payer have to withhold 10% or depending on the tax rate. So and the amounts that payer will have to pay to the IRB is within 30 days. So next. Okay, so this is the rates of withholding tax. Okay, the rate is levied in accordance with a specific.
Please put the presentation into slide mode. Presentation mode. Pergi dekat slideshow. Or from current slide tu boleh kat atas tu on your left.
Tapi saya dah buka besar, doktor, tak tahu kenapa dia tak keluar.
Oh, I see. Okay. Tak apa.
Okay, so so the expenses or approved donation incurred by non-resident will not be taken into consideration when withholding tax is computed. So as you can see, this is the payment and the rate and the tax rate. So for special classes of income, the tax rate is 10%, interest 15%, royalties 10%, contract payment 10% plus 3%, public entertainer 15%, and other income under section 4 subsection F 10%. So other than contract payment, which is the 3%, is the withholding tax, is a final tax. Okay, so what is meant by final tax is once you have withhold the amount tax, so non-resident doesn't have to pay any more tax on the same income. It means that we cannot tax them twice in the same income. So, and the non-resident did not account for further Malaysian tax one that withholding tax has been complied with. Next. Okay, contract payment. Okay, contract payment is actually a contract between a person with another person, and withholding tax for contract payment is 10% plus 3%. And the 10% is for the non-resident contractor tax liabilities, while the 3% is for the tax employees of the non-resident contractor. Okay, it means that the 10% of the tax is on the company, and the 3% is on the employees of the company who are the non-resident person. Okay, non-resident contractor is said to be carrying on a business in Malaysia, and he will submit the tax computations and determine the chargeable income, and the income tax payable will be computed. So whatever payment received as a non-resident on the contract payment, 10% have been deducted by the payer. So the amount of 10% deducted is actually the tax paid by us on the contract payment. So next slide. It's the responsibility of the payer. The payer is the agent for the non-resident when the payer made the type of payment to non-resident, and when the payer made the payment or credit such payment to the non-resident within 1 month after paying or crediting such payment. Paying or crediting means that sometimes we credit in our account, for example, using check. So, but it is not the date the non-resident received the check, but it is actually the for example, using checks. So, but it is not the date that non-resident received the check, but it is actually when we credit our account for the payment to the non-resident person. Okay, so next. Okay, so I will pass to Amira.
Okay, for royalty is defined as any sum paid as consideration for the use of or the right to use, copyright, artistic or scientific work, patent, design or model, plan, secret processes or formula, trademark or tape for radio or television broadcasting, motion picture films or videotapes, or other means of reproduction where such film or tapes have been or are to be used or reproduced in Malaysia, or other like property or right. Know-how or information concerning technical, industrial, commercial or scientific knowledge, experience or skill, and income derived from the alienation of any property or information mentioned in above paragraph of this definition. The gross amount of royalty paid to a non-resident payee is subject to withholding tax at 10% or any other rate as prescribed under the double taxation agreement between Malaysia and the country where non-resident payee is tax resident. For derivation of income, royalty income is deemed to be derived from Malaysia if responsibility for payment lies with the government or a state government or a local authority, or responsibility for payment lies with a resident of Malaysia, or the royalty is charged as an outgoing or expense against any income occurring in or derived from Malaysia. The payer must within 1 month after the date of payment or crediting the royalty remit the withholding tax, whether deducted or not, to the Inland Revenue Board Malaysia. For deduction of withholding tax, the payer is liable to pay a royalty which is deemed derived from Malaysia to non-resident. He shall upon paying or crediting the royalty, deduct 10% of the royalty as withholding tax. The non-resident would only receive 90% of the royalty income. The withholding tax shall be paid to the tax authorities within 1 month after paying or crediting such royalty to non-resident. For derivation of income for interest, interest income is deemed to be derived from Malaysia if responsibility for payment of the interest lies with the government, a state government or local authority, or if responsibility for payment of the interest in the basis year for a year assessment lies with a person who is resident for the basis year and it is payable in respect of money borrowed by that person and employed in or laid out on asset used in or held for the production of any gross income of that person derived from Malaysia, or the debt in respect of which the interest is paid is secured by any property or asset situation in Malaysia, which means these 2 points is must have must make the condition, so the interest would be count. And the last condition is if the interest is charged as an outgoing or expense against any income occurring in or derived from Malaysia.
Amira, for the next one, I mean, whenever you have the derivation of income, I think that the previous group, the second group, has actually go through into this topic, right? So I think that is the same. So you may skip the derivation of income for your presentation.
Okay. In these interest that are not subject to withholding tax are interest paid to a non-resident payee on an approved loan, and interest paid to a non-resident payee by a licensed bank or licensed finance company in Malaysia, other than interest occurring to a place of business in Malaysia of the NR payee, and interest on fund required for maintaining networking fund prescribed by Bank Negara. Interest paid to a non-resident payee is subject to 15% withholding tax or any other rate as prescribed under the double taxation agreement between Malaysia and the country where the non-resident payee is a tax resident. For income of non-resident public entertainer is defined as a stage, radio or television artist, a musician, athlete or an individual exercising any profession, vocation or employment of a similar nature. Remuneration or other income in respect of services performed and rendered in Malaysia by a non-resident public entertainer is subject to withholding tax of 50% on the gross payment. For the resident status, generally a public entertainer will be treated as non-resident if he is in Malaysia for less than 182 days in a calendar year. Sponsor of the non-resident public entertainer is required to pay withholding tax of 15% before an entry permit for the non-resident public entertainer can be obtained from the immigration department. Okay, next I will pass to Nova.
Thank you, Amira and Raisha. Next, I will continue with the special classes of income. Special classes of income paid to non-resident payee is subject to Section 4A and Income Tax Act 1967. Under special classes of income, there are three types. The first one is payment for service rendered by the non-resident payee or his employee in connection with the use of property or right belonging to or the installation or operation of any plant, machinery, and apparatus purchased from the NR payee. The meaning here, it is only focused on the use of property or rights and also the installation or operation of any plant and machinery. For example, if we buy a machine from China and we have to use their the person there to install the machine in Malaysia, we have to pay the expert there. So when we pay that person are required. When we pay the person are subject to withholding tax. The next one is payment for advice given or assistance or service rendered in connection with the management or administration of any scientific or commercial undertaking, venture, project, or scheme. This is also include the administrative services such as HR, staff training, IT support, and testing or inspection of services and products. The next one is rent or other payment made under any agreement or arrangement for the use of any movable property. This is limited to lease rental for use of movable property such as boats, motor vehicle, aircraft, oil rigs, and other plants and machinery. Payment that made to an payee in respect of the above are subject to withholding tax of 10%. Next. Okay, the next one is other income. Non-resident receive income as bulleted in Section 4F, such as commission income, will be subjected to withholding tax of 10% on the gross income if such Section 4F is deemed derived from Malaysia. The derivation of income actually is the same as the previous one, so I will skip this one. Next. Okay, this is an example of Section 4F. Melissa, the payer, is a Malaysian resident that pay 40,000 commission to Michael, and a non-resident of Malaysia, for successfully closing a property deal in Malaysia where Michael was only acting on his own as a middle person. Since this payment is not a business, employment or rental income for Michael, it is deemed as income falling under Section 4F of Income Tax Act 1967 and is subject to a 10% withholding tax. The amount of withholding tax that Melissa has to pay is calculated as follows. The commission to be paid to Michael is 40,000. We must minus the withholding tax 10% from the commission, which is 4,000. So the amount to be paid to Michael is 36,000. The amount of withholding tax of 4,000 is to be remitted by Melissa to the Inland Revenue Board of Malaysia within 1 month after payment is made or credited to Michael. Next. Okay, this is an enforcement and penalty. The following constitute a non-compliance when
The payer fails to pay withholding tax at the prescribed rate. The payer fails to pay withholding tax within a month after date of payment or crediting to the NR payee. The payer fails to pay increased tax imposed for late payment of withholding tax or failure to pay withholding tax. A sum equal to 10% of the amount failed to be paid is added on to the initial tax amount. The penalty is only imposed on the payer. So we are going back to the scenario between Melissa and Michael just now. Should Melissa make a late payment, the new amount to be paid will be the withholding tax out before is 4,000, add up with the penalty of 10% from the withholding tax owed, 400. So the revised amount will be 4,400 ringgit. Okay, that's all from us. Thank you. Any question?
Oh, you don't cover the incorrect returns, is it? It's not part of the withholding tax topic.
The what?
Incorrect returns?
Penalty for incorrect returns?
Mm.
Oh, I
So you also have the other topic where we talk about what is the implication of non-compliance to withholding tax.
I think.
So for example, all right, let's say if a payer fail to comply, here you say that comply means that either you do not withhold or you do not pay within the time, or the one that you mentioned just now, right? So what happened to the payer? What is the implication of non-complying? And then there's
they will be imposed with 10%.
that is the penalty.
Yeah.
Yeah, that's actually macam ni, alright? Because they have not covered, so I have to add on a bit. So under withholding tax, assuming that a company A pays royalty to a non-resident, a person, okay? Let's say the royalty is 100,000. So how much is the tax rate for the royalty? What is the withholding tax? Royalty? 10 or 15%? 10.
10.
What is the withholding tax for royalty?
1,500.
No, the rate.
10%.
10%. Right, you go back to the schedule earlier. Okay, so 10%. So it means that from 100,000 royalty expense, you have to pay to the non-resident 90,000. So the 10% you have to withhold. Okay. So what happened here is that what appears in your profit and loss account should be royalty expense of 100,000. Okay, but it's just that you pay 90,000 to the non-resident, the balance 10,000 you keep and pay to RB within 30 days. So what happens if you fail to comply? When fail to comply means that maybe the amount that you keep 10,000, you did not actually, you fail to remit to RB within 30 days. So that is the non-compliance. So what happened to non-compliance is that the whole amount of your royalty, how much the royalty? How much the royalty expense?
10%.
Royalty tu berapa? 10% tu withholding tax. How much the royalty expense? Berapa? Ayo.
Doctor, can you repeat the question?
Okay. So now company A pays to company B. Company B is a non-resident person. So company A pays royalty 100,000 to companies B. Because it's a royalty and the company B is a non-resident company or person, then you have to apply withholding tax. So how you apply is that instead of paying 100,000 to company B, you have to only pay 90,000. You withhold 10,000, 10% of it, and then you pay to RB within 30 days. So what happens if you do not comply? Alright, if for example you fail to pay to RB within 30 days, so that's when we say that it's a non-compliant. So what happens is that upon non-compliance, the whole royalty expense 100,000 to the payer becomes non-deductible expense. So you have to add back 100,000. You understand that? So it's a very important because implication because if you do not comply with withholding tax, that will add to your tax liability, because by right, the royalty should be a business expense. But just because you fail to comply with the withholding tax, the amount of royalty expense now becomes non-deductible. So you have to add back 100,000. Okay? Okay, what happened now is that the new regulation says that, okay, remember that your year end is, let's say your company year end is 31st of December. Okay, so normally the auditor will comes in after December and then they found out, hey, why have you not complied with the RB, right, with the withholding tax provision? So what they can actually advise you is that now the new rule says that if you have not complied, all right, remember things has happened, all right, now you have not paid the 10,000 to RB. So what you can do now is that you pay the 10,000, the amount owed, for example, the case of Melissa just now, plus the penalty of 400, right? So let's assume that the amount owed is 4,000 plus penalty of 400. So you pay to RB before submission of your Form C. So if the company year end is 31st of December, when should the company submit Form C? Anyone? When should a company submit Form C? Hello, advanced tax. Ah, sudah. Ah. Anyone? When is supposed to submit your Form C?
15 December.
Okay, your year end is? When's your year end? 31st December. Let's say your year end is 31st December 2019. When should you submit your Form C to Inland Revenue Board?
I think 7 months after.
Ada pun 7 months after your closing. So when is that? By 31st of July, right? So when it comes to withholding tax, you are given 7 months to pay the withholding tax plus the penalty, right? So if you settle all these amount owed plus the penalty, you pay before you submit your Form C, the whole amount, just now royalty is 100,000, right? The whole amount becomes deductible. So you can claim that as your deductible expense, provided that the withholding tax owed plus the penalty is settled before the submission of your Form C, right? Understood? Yes. What happened is that you have not paid for the withholding tax owed, you did not pay for the penalty, and you submit your Form C claiming for the 100,000. So in that case, is that correct or wrong?
Wrong.
Can you claim your royalty as 100,000 if you have not complied with?
No.
You cannot claim. Yeah, you cannot claim your royalty as 100,000 if you have not settled your amount owed to the government. But if you submit your Form C without settling all these things, then the submission is known as an incorrect returns. So the incorrect returns, the penalty is 100% of the tax under charge. Right? So that is the implication. Number 1 is the non-compliance. Number 2 is the incorrect returns. Please refer back to your textbook or even of the public rulings. Is there any public rulings on withholding tax? I think there is. Yeah. So they give you an example and then please check the latest public ruling on withholding tax. There are a lot of changes actually. Yeah. So that's it on the presentation of withholding tax. I think that this should be topic for your tax 1 or tax 2. So this is a revision, right? And remember that your advanced tax question could give you a scenario, right? And then we can give you scenario, there's a transaction between A and B. B is a non-resident, and why you say B is a non-resident, and then you have to justify whether subject to withholding tax or not, and if yes, you have to justify why. And normally it goes back to the derivation of the income. Yeah, whether the income is derived in Malaysia or not by the non-resident person. If the income is derived in Malaysia, then the non-resident is subject to withholding tax, provided that the income falls under A, B, C, D, E, and F. Okay, right. So that covers for the presentation. We have the other group is on, what is the other group? I think it's on permanent establishment. All right, it's a big topic. The group, can you present that in the following class? Is that okay?
Okay, Doctor.
Yeah. Right.
Okay,
Remember,
Doctor.
even though presentation is only affects one group on the topic, but remember that everyone will be tested on the topics presented in your final exam. Yeah, so if you do not understand any of the presentation, you better ask immediately so that you get the ideas and you understand the topic before the final exam. Yeah, so I hope that everyone benefits from this exercise, and I hope to see you again next class, inshallah, on, oh, today dah Wednesday, ya. Do we have class on Ahad, Sunday?
Yes.
Oh, belum start lagi ya, you punya semester break?
No, haven't.
Okay, then we see you on Sunday lah. Okay?
Alright,
And
Doctor.
I think that you have not decided on your midterm test date when you want to have the exam. Yeah, please discuss with your group so that we can decide on the date. So with that, I thank you again, everyone. I hope to see you again next time. Please, those who have presented, alright, I think that only have derivation, income definition je ada, baru slide. Alright, the other 5 groups I have not received yet, the slide. Right, you can just put that into the group project punya group project assignment. Right, so then I put back into the material so that you can, everyone can refer to the material. Right?
Doctor.
Yes.
Doctor, only one person need to
Yeah,
submit the
yes, only one person je. I nak satu presentation je, satu group.
Okay.
Right. Alright, thank you again. Any more question? Alah, I lupa nak stop recording. Alright, thank you again, and you may leave. For Muslim, please